Let's go. 25 mortgage loan origination practice questions to help you study for that NMLS mortgage licensing examination. And without further ado, let's get into it. Here we go. Question number 1. Question number 1. How long do creditors have to retain the loan estimate, also known as the LE? Letter A, 1 year. Letter B, 3 years. Letter C, 5 years. Letter D, 7 years. And the answer is letter B, 3 years. Okay, so creditors have to maintain records for specific documents for specific amounts of time. This is definitely territory that I would study as you are preparing for mortgage licensing examinations. They're definitely going to want to, you to know, and you're going to study this in the various courses that you're going to take all over the country. They want to know certain retention rates, and this is an important one. So you want to know the TRID rule, and inside of the TRID rule, you're going to learn about how long creditors are expected to maintain these documents, and the LE, the loan estimate, in this case has to be held for 3 years. Now note, other documents have to be held for 5 years, so make sure you do study these, and it is a priority. I would definitely know how long you need to keep certain documents. Also to that note, sometimes there are state-specific documents that you won't be tested on for this examination that you might have to keep in your storage in order for to be in compliance with state licensing requirements as well as the CFPB requirements when they do audits. Question number 2. What is the penalty for violating the FCRA, also known as the Fair Credit Reporting Act? Letter A, civil penalties only. Letter B, possible prison time only. Letter C, potential civil penalties and prison time. Letter D, civil penalties up to a maximum of $1,000. And the answer is letter C, potential civil penalties and prison time. Okay, so some of these laws that you're going to be coming across, things like the FCRA, the Fair Credit Reporting Act, FACT Act, RESPA, TILA, Equal Credit Opportunity Act, the Fair Housing Act, all of these different laws, Graham-Leach, Belisle, all of these different laws, you're definitely going to want to know each of them. So that's a little bit of the cumbersome sort of nature of the beast of this examination that you're definitely going to need to know some depth about these laws. But you're also going to need to know what some of these penalties are for violating. And in some instances, like, for example, what is the penalty for violating the SAFE Act? And what is the penalty? So here in this particular question, they're asking us, what is the penalties for violating the Fair Credit Reporting Act? And if you were to read the statutes and some of the enforcement actions, you're going to find that there is a potential for civil monetary penalties and a potential for criminal prison time. Okay? So you want to know that for the Fair Credit Reporting Act. Let's move on to the next one. Question number 3. What were the 2 original protected classes under the ECOA in 1974? The ECOA stands for the Equal Credit Opportunity Act. Letter A, race and color. Letter B, age and sex. Letter C, race and age. Letter D, sex and marital status. And the answer is letter D, sex and marital status. Okay, so protected class status in the Equal Credit Opportunity Act, I would definitely memorize the protected class status. And if you remember, race, color, religion, national origin, and sex are covered in both the Fair Housing Act and the Equal Credit Opportunity Act. And then Equal Credit Opportunity Act has those 3 additional protected classes: public assistance recipiency, marital status, and age. So we want to know those 3 additional items for Equal Credit Opportunity Act, but in this particular question, what were the 2 original protected classes under the ECOA? Sex and marital status, definitely on there.
Before 1974, credit market obstacles prevented women from fully entering the consumer economy that arose in the U.S. after World War II.
Women applying for a credit card or a loan could expect to be asked a host of personal questions.
These questions often pertained to their marital status, and asked whether women had available and willing male co-signers such as husbands, brothers, fathers, uncles, or friends.
Even if the woman had full potential to repay the loan or credit card, banks would often discriminate based on reasons that had no bearing on financial abilities.
Without a male co-signer, banks were unwilling to lend a woman money. severely inhibiting a woman's financial freedom and economic opportunities.
In the 1971 seminal legal case, Reed versus Reed, Ruth Bader Ginsburg co-wrote a brief arguing against a provision of an Idaho state law regarding the preference of men over women as administrators of an estate.
The court agreed with Ginsburg and her colleagues, ruling unanimously that dissimilar treatment, on the basis of sex, between men and women was unconstitutional.
This ruling paved the way for the Constitution's 14th Amendment and Equal Protection Clause to be applied to gender discrimination cases.
3 years later, and amid a wave of activism, Congress passed the Equal Credit Opportunity Act in 1974. The act specifically banned discrimination against a financial borrower on the basis of sex or marital status.
A little bit of history, they won't test you on this, but that's just the reason why that sex and marital status were the two original protected classes. So hopefully that helps you in understanding, so why were those two versus, race and color and race and age and sort of why, okay? Hopefully that helps. We'll see you in the next one. Question number 4. Under the SAFE Act, which entity oversees MLO licensing? Letter A, NMLS. Letter B, the FTC. Letter C, the AARMR, or letter D, the FDIC? And the answer is letter A, NMLS, which stands for the Nationwide Mortgage Licensing System. All right, so these are all actual acronyms and initialisms that stand for something. So that's one thing. This examination will certainly have acronym soup or alphabet soup here, as I like to think of it, because there's all kinds of little initialisms and acronyms and things that'll help you, but there's actual government entities that have these names to them. So like the FDIC, the AARMR is the American Association of Residential Mortgage Regulators. The Federal Trade Commission is the FTC. So you just want to know that there are these things. Now, the SAFE Act is the Mortgage Licensing Act, and the entity that oversees this MLO licensing piece, according to the SAFE Act, is the Nationwide Mortgage Licensing System, the NMLS. Question number 5. Which is not included in the 4 C's of underwriting? Letter A, credit. Letter B, capacity. Letter C, collateral. Letter D, commitment. And the answer is letter D, commitment. All right, so credit, capacity, and collateral are 3 of the 4 C's of underwriting, and commitment is not. You want to know what the 4 C's of underwriting are? This is a very popular learning objective inside of the outlines that you're presented with for these mortgage licensing examinations, and they do cover these in various textbooks and various materials across the country, and I've seen them all. So just know that this is something that I would focus on just to understand sort of how the process and procedure of underwriting and qualifying an applicant goes. And these are the 4 C's of underwriting. Question number 6. Which of the following is not one of the initial 6 items of information needed for a complete mortgage loan application? Letter A, the names of all the borrowers. Letter B, the borrower's marital status. Letter C, the gross monthly income of the borrower. Letter D, the loan amount being sought. And the answer is letter B, the borrower's marital status. Okay, so there are 6 elements that you need to know for a complete application. And these are items that you definitely will see on practice questions and on outlines for the mortgage loan originator's exam. So you definitely want to know these 6 items. As a matter of fact, these 6 items, once they are acquired, whether it be on a mortgage application or whether it be on the back of a napkin, those 6 items, once you have them, that is going to trigger the disclosure requirements under many of these federal laws, including the disclosure of the loan estimate, okay? So you want to know what a complete mortgage application is, and you want to know what the items are that are not required. Like in this particular question, you want to know that the names of all borrowers are required, the gross monthly income, the loan amount being sought, things like the appraised value of the property, all critical pieces of information. But the borrower's marital status is not essential in order to have a complete loan application. Question number 7. According to the Truth in Lending Act, when a triggering term appears in an advertisement for a mortgage loan, the ad must also disclose the following information. Letter A, the term of the loan. Letter B, the annual percentage rate. Letter C, the amount of the payment. Letter D, all of the above. And the answer is letter D, all of the above. Okay, so Truth in Lending Act, definitely something to study. Regulation Z, the advertising components of Reg Z, or Truth in Lending Act. And you definitely want to know what trigger terms are. You're going to learn about these in all of these books that you're going to be studying. And you want to focus in on the things that could be trigger terms. It could be an example of a trigger term. But you want to know that the APR has to always be present. You want to know that the amount of the payment, the term of the loan, any specific details when somebody says super low rates or 3% rates or 2% rates, and that's it. We're going to have to trigger stuff. Now, the only thing that can stand alone in an advertisement, if you were like looking at a billboard and you saw like APRs as low as 2.781 APR can be advertised specifically, and that's sufficient. You don't need to have any further clarification of that. So that could be another angle or approach when it comes down to studying. Just understanding trigger terms and sort of the different variations, the variants, the differences in sort of how questions might be brought. That would be essential. I would focus on that. This is a good question. We'll see you in the next one. Question number 8. Which legislative act passed in 2008 established minimum standards for mortgage loan originators licensing and registration? Letter A, the Dodd-Frank Wall Street Reform and Consumer Protection Act. Letter B, the Housing and Economic Recovery Act, or HERA. Letter C, the Secure and Fair Enforcement for Mortgage Licensing Act, or the SAFE Act. Letter D, Truth in Lending Act, or TILA. And the answer is letter C, the SAFE Act, or the Secure and Fair Enforcement for Mortgage Licensing Act. Definitely want to know bits about these different laws, the Dodd-Frank Wall Street Reform Act, the HERA Act. HERA, I would understand, is the Housing and Economic Recovery Act, which was sort of the thing that we wrote first to sort of address the failing economy and the problems that we're having with the subprime mortgage markets, et cetera. And then Dodd-Frank kind of came in after that, sweeping and sort of modified and codified and sort of rectified and clarified all of these different pieces of different laws, things like the TRID rule and everything else came out of that. And then the SAFE Act was written in 2008, and then that thing was basically saying, hey, listen, back before all of the SAFE Act, the mortgage originators weren't licensed to any degree. There were no standards for state licensed originators, so we need to fix that. And then that's when the SAFE Act was passed. So SAFE Act was in 2008, and then the Dodd-Frank Wall Street Reform Act was in 2010. So you want to kind of know the dates and sort of the relevance and how these things kind of fit in the fray of mortgage origination. But the SAFE Act, this is a good question, and we'll see you in the next one. Question number 9. A home buyer currently receives public assistance for their living expenses, but will be starting a full-time salaried position within the next 2 weeks. Given the circumstances, which of the following would be considered a violation of the Equal Credit Opportunity Act, or the ECOA? Letter A, the lender encouraging the borrower to wait until their new job starts before they submit their application. Letter B, asking the borrowers detailed questions about their public assistance status during the application process. Letter C, requiring the borrowers to provide a letter from their future employers confirming their new job before processing the application. Letter D, none of the above. And the answer is Letter A, the lender encouraging the borrower to wait until their new job starts before they submit their application. So once a lender has been notified of these conditions, then it's a stitch in time. Now it's been verified. The lender has heard this information, and now the lender has to address this information and simply cannot say, or coach the borrower into doing various things. These are very important ethics-based questions, and ethics is a piece of this examination. So we definitely want to learn and understand this stuff. Now, these can be challenging questions because many times students have to interpret and understand what ethics is, which is sort of a cut above the law. And so you want to make sure that you're careful about approaching this. Sometimes if you read the question answers first and then read the question, sort of look at the answers, then read the question, ethics questions can become a little bit more easier to understand because you're starting to see sort of this difference between law and the moral and ethical fiber of what a loan originator needs to do. All right, this is a good question. We'll see you in the next one. Question number 10. The Fair Housing Act prohibits discrimination against all of the following classes except letter A, familial status, letter B, religion, letter C, age, letter D, national origin. And the answer is letter C, age. Okay, so the protected classes, the difference between the Federal Fair Housing Act and the Equal Credit Opportunity Act is a must as you are studying for examinations like this and other examinations. They definitely want you to understand the similarities and, important, the dissimilarities. So you want to make sure you know, so Fair Housing Act is race, color, religion, national origin, sex, familial status, and disability. And the Equal Credit Opportunity Act is the same first five: race, color, religion, national origin, and sex. And then the ECOA has age, marital status, and the receipt of public assistance recipiency. And all of these are different and similar. So you want to know these. And so age is not fair housing, but age is ECOA. So you want to know these and understand the differences, and that's going to serve you well when you're studying for examinations of this type. Question number 11. Which federal agency oversees the regulation of Fannie Mae and Freddie Mac? Letter A, the Department of Housing and Urban Development, or HUD. Letter B, the Federal Reserve System, or the Fed. Letter C, Federal Housing Finance Agency, the FHFA. Letter D, the Consumer Financial Protection Bureau. And the answer is letter C, the Federal Housing Finance Agency, or the FHFA. Okay, so HUD ultimately is this, the main organization that oversees America's housing needs. The CFPB, or the Consumer Financial Protection Bureau, oversees all of the enforcement actions for the legislation. And then the Federal Housing Finance Agency, which actually sits inside of HUD, oversees the operations of Fannie Mae and Freddie Mac. It's an important understanding to kind of know who the sheriffs are and know what where the enforcement actions are, etc. Now, it makes it easier for this examination knowing that the CFPB is the enforcer for all of these federal laws, basically for the mortgage licensing programs. So that's pretty easy to remember, but you definitely want to know the FHFA, as this is something that you want to know that oversees Fannie Mae and Freddie Mac. And Fannie is the Federal National Housing Administration, and Freddie Mac is the Federal Home Loan Mortgage Corporation. Question number 12. Which of the following is a key requirement outlined in the Statement on Subprime Mortgage Lending issued by the Federal Reserve in 2007? Letter A, encouraging lenders to offer subprime mortgages with variable interest rates. Letter B, reducing the minimum credit score requirements for subprime mortgage applicants. Letter C, promoting the use of teaser rates in subprime mortgage advertisements. Letter D, verifying and documenting borrowers' income, assets, and liabilities. And the answer is Letter D, verifying and documenting borrower income, assets, and liabilities. So prior to the Dodd-Frank Wall Street Reform Act, we had this statement on subprime mortgage lending issued by the Federal Reserve, and it was issued in 2007. And basically at that point, they were saying, hey, listen, the statement that we're making is we really should be documenting borrowers' incomes, assets, and liabilities. And then, of course, as the Dodd-Frank Wall Street Reform Act gets placed into power, the idea of the ability to repay rule becomes a part of our tapestry when it comes down to lending, as you'll learn in the different sections in your learning manuals. Various books across the United States offer this, various programs, and you'll see that. So the ATR rule, the ability to repay rule, as its genesis comes from this statement on subprime mortgage lending. And the idea here is, hey, listen, it's important that we verify income, because back then they had no income, no asset, no verifications of many of these different mortgage products, and that led to the mortgage meltdown in 2008 and the passing of the SAFE Act and the passing of the Dodd-Frank Wall Street Reform Act and the economic crisis and all of that other stuff that came prior to this. Question number 13. How many hours of continuing education does the SAFE Act require MLOs to have? Letter A, 8 hours. Letter B, 12 hours. Letter C, 24 hours. Letter D, 40 hours. And the answer is letter A, 8 hours. Okay, so every year, annually, loan originators licensings of loan officers are required to take the continuing education. So federally registered loan officers do not need to take continuing education, but state-approved loan officers do. And that is 8 hours. There is a core requirement annually of continuing education. That core is 3 hours of federal law, 2 hours of ethics and fraud, and 2 hours of non-traditional loan products, and 1 hour of elective study. Now, some of the states across the United States will allow that 1 hour of elective study to be a component of their specific requirements if they happen to have them. And if you roll them in, that's called a comprehensive course. So some of y'all might be taking comprehensive CE. Some of you might be taking core CE. It's all the different names of this stuff. That's how it all kind of comes together. But 8 hours is what is required annually, and the successive year rule states that you can't take the same CE course every year. And each CE course is approved by the NMLS and the CSBS, and they're given specific approval numbers. And those approval numbers can't be the same in each successive year, so you have to take new CE every year. And that's the CE. So 8 hours, this is a good question. You're going to see stuff like this, I would suspect, on mortgage licensing examinations because it's a piece of it. Question number 14. Which of the following is an example of predatory lending in mortgage finance? Letter A, offering competitive interest rates based on the borrower's credit score. Letter B, charging excessive fees and points that inflate the cost of the loan. Letter C, providing transparent loan terms and conditions to the borrower. Letter D, allowing borrowers to choose from various mortgage products to suit their financial needs. And the answer is letter B, charging excessive fees and points that inflate the cost of the loan. So predatory lending, definitely terms that you want to know for exams. Predatory lending are things that you definitely want to understand. Things like fee packing, excessive fees, non-verification of income, teaser rates, negative amortization. These are all terms that are very popular on predatory lending sections. And you want to know the definitions, and you also want to understand, as you're studying those sections, the relevance and the explanations of those things. And they do dovetail into mortgage fraud and the ethics topics. So you'll typically see those in those sections of your materials. Question number 15. Which legislative act prohibits redlining in mortgage lending? Letter A, the ECOA. Letter B, the Fair Housing Act. Letter C, the SAFE Act. Letter D, HERA. And the answer is letter B, the Fair Housing Act. Okay, so redlining is a prohibited practice. It is a discriminatory practice where it's not making a loan or making an insurance offering in an area for reasons other than economic qualification. And redlining is a prohibited practice under the Fair Housing Act. The Equal Credit Opportunity Act doesn't have it listed, but blockbusting, steering, and redlining are listed under the Fair Housing Act. So you want to know those definitions, and you want to definitely know discrimination. You will see discrimination questions, I would assume, on mortgage exams. Very popular, ECOA and the Fair Housing Act, and sort of how their interplay works and how they're different in protected class statuses, etc. So definitely a good question. Let's see in the next one. Question number 16. Someone who purchases property or obtains a loan on behalf of another person to conceal the true buyer's identity or financial situation, often for fraudulent purposes, is referred to as an letter A, proxy buyer, letter B, investment trust buyer, letter C, bona fide buyer, letter D, straw buyer. And the answer is straw buyer. Okay, so straw buyer is definitely a vocab phrase that you want to know for real estate examinations and mortgage finance examinations. It's a very popular term. You definitely want to look at it. You'll see these in the ethics and fraud sections many times, and you want to study sort of what a straw buyer is and sort of how they operate and what they do. They could be a scenario-based question, or it could be a straight up, what is a straw buyer style question, like in this particular question. Good question, and we'll see in the next one. Question number 17. Which of the following is not an example of predatory lending in mortgage finance? Letter A, charging excessive fees and points that inflate the cost of the loan. Letter B, misleading the borrower about the terms and conditions of the loan. Letter C, offering competitive interest rates based on the borrower's creditworthiness. Letter D, requiring borrowers to purchase unnecessary insurance products. And the answer is letter C, offering competitive interest rates based on the borrower's creditworthiness. Okay, so many times writers will say, which of the following is not an example, or which of the following is an example of. So you just want to kind of look out for those. And if in this particular style of question, you want to always read the answers first if you could. And you'll kind of go, okay, these are thematically the same, letter A, B, and D. These are all answers that are sort of negative. And then C is a positive thing. And so you can easily identify many times on exam questions these. Which of the following is not an example of, or which of the following is an example of? So these, in my opinion, are fairly easy to grasp because you can just look at the answers and then sort of reverse engineer what the question might be. Okay, good question, and we'll see in the next one. Question number 18. A mortgage finance strategy that involves taking out two mortgages at the same time to eliminate the need for PMI when the borrower is making a down payment of less than 20% is known as letter A, loan stacking, letter B, equity skimming, letter C, conforming loan modification, letter D, piggyback financing. And the answer is letter D, piggyback financing. Okay, these are just vocab phrases. These are like, what is the definition of something and what is the vocab phrase? And that's what these are. Equity skimming is legit. Piggyback financing is legit. Conforming loan modification is a thing, but that's not a mortgage financing strategy that involves taking out two mortgages. And then loan stacking is a thing, but it's not this thing. So this is a good old classic, what is this thing vocab phrase. These are good to study. These are good with learning vocabulary phrases and learning sort of definitions. And we'll see in the next one. Question number 19. What do caps on adjustable rate mortgages or ARMs primarily limit? Letter A, how much the interest rate or monthly payment can change over time. Letter B, the maximum loan amount a borrower can qualify for. Letter C, the number of years before the mortgage must be refinanced. Letter D, the total amount that can be financed. And the answer is Letter A, how much the interest rate or monthly payment can change over time. Now, you will definitely see in terms of non-traditional mortgage product sections how an adjustable rate mortgage works. And you want to know things like caps and life caps and floors and those types of things, and adjustment options, and sort of how the adjustable rate mortgage typically works, what a hybrid arm is, and sort of what the indices are that sort of connect to them. And those are all useful phrases to understand, but adjustable rates are definitely things that you want to know functionally on mortgage licensing examinations. They're definitely in the outlines, and I would focus on these as you are studying. Good question, and we'll see you in the next one. Question number 20. What is the primary purpose of the Regulation V under the Fair Credit Reporting Act, or FCRA? Letter A, to set interest rate limits for mortgage loans based on the borrower's credit scores. Letter B, to ensure the accuracy and fairness of consumer credit reporting by lenders. Letter C, to mandate the maximum loan-to-value ratio for mortgage transactions. Letter D, to establish guidelines for down payment requirements in mortgage applications. And the answer is letter B, to ensure the accuracy and fairness of consumer credit reporting by lenders. So the Fair Credit Reporting Act primarily is written to ensure the accuracy and fairness of consumer credit reporting by lenders. And that's something that you're going to learn. You're also going to learn about the FCRA and FACT Act in your courses. And the Fair and Accurate Transactions Act is also an important function of Fair Credit Reporting Act. It's a modification of it. And you're going to learn about all of these different federal laws, and they're important and essential in this particular subject for examination purposes. So you definitely want to know Regulation V. And a little cheat is think of Reg V, V for Visa. A Visa is a type of credit card. Think of Visa, your credit card. And a Regulation V deals with the Fair Credit Reporting Act or credit. So that's sort of an easier way to remember sort of, okay, what is Regulation V versus Regulation B versus Regulation Z versus Regulation X? So all of these different letters, and it helps you to kind of think of mnemonic devices that'll help you there. Question number 21. What is a loan workout in the context of banking and finance? Letter A, a process where a borrower takes out a new loan to pay off an existing loan at a lower interest rate. Letter B, an agreement between a lender and a borrower to modify terms of an existing loan to prevent default. Letter C, a financial strategy where a borrower refinances their mortgage with their higher balance than what they currently owe so that they can access their equity. Letter D, a government program providing subsidies to borrowers facing financial difficulties. And the answer is letter B, an agreement between a lender and a borrower to modify the terms of an existing loan to prevent default. So the key phrase here is loan workout. Hey, can we work out something agreeable between us parties, lender and borrower, so that we don't go into default if we're the borrower, and that the lender can feel that they're able to get recompensed for their particular risk or obligation, okay? So this is a good question. Loan workout, again, definition of something, and then again, give you a bunch of scenarios, and you're just going to have to pick the correct one. Many times, again, on these types of questions, I would read the answers before I read the question, just to get primed and understand what could be a question coming at me. I might be able to just say, based off of all of the answers, hey, this is the definition of a loan workout. Question number 22. Borrower Jeannie is a salaried employee and is paid bi-weekly in the amount of $5,384.62. What is her monthly qualifying income? Letter A, $10,398.80. Letter B, $10,769.24. Letter C, $11,666.67. Letter D, $12,833.34. And the answer is letter C, $11,666.67. Okay, for an explanation of this, let's check out the breakdown. You're going to definitely need to know how to calculate regular income for qualification purposes, as one of the sections of your MLO examination is qualification processes and mortgage origination. So let's go through this right now, and then we'll go through how we calculate some regular income in this particular question, and we'll get back to that in just a second. Question number 23. What distinguishes a balloon mortgage from a traditional fixed-rate mortgage? Letter A. Balloon mortgages have adjustable interest rates, while fixed-rate mortgages have a consistent interest rate throughout the loan term. Letter B. Balloon mortgages allow borrowers to make interest-only payments for the first few years of the loan, unlike fixed-rate mortgages whose payments consist of interest plus principal. Letter C. In a balloon mortgage, the portion of the monthly payment allocated to the principal balance increases gradually over time, whereas in fixed-rate mortgage, this allocation remains consistent throughout the loan term. Letter D. Balloon mortgages require a large final payment at the end of the loan term, whereas fixed-rate mortgages do not because they are fully amortized. And the answer is letter D. Balloon mortgages require a large final payment at the end of the loan term, whereas a fixed-rate mortgage, they do not because they are fully amortized. And we definitely want to know the difference between a traditional fixed-rate mortgage and the different non-traditional loan types like a balloon mortgage, understanding that a balloon mortgage is a partially amortized loan and a traditional fixed-rate mortgage loan is a fully amortized mortgage loan. Question number 24. On a closing disclosure for real estate transactions, what distinguishes accrued expenses from prepaid expenses? Letter A. Accrued expenses are costs incurred before the closing date but not yet paid, while prepaid expenses are costs paid in advance by the seller for services or obligations that extend beyond the closing date. Letter B. Accrued expenses are costs that have been paid in advance by the seller, while prepaid expenses are costs incurred but not yet paid. Letter C. Accrued expenses are costs paid by the buyer prior to the closing date and allocated to future periods, while prepaid expenses are costs already incurred and paid by the seller up to the closing date. Letter D. Accrued expenses are future costs that are included in the loan amount and will be paid off over time, while prepaid expenses are costs paid upfront and include the closing costs. And the answer is letter A. Accrued expenses are costs incurred before the closing date but not yet paid, while prepaid expenses are costs paid in advance by the seller for services or obligations that extend beyond the closing date. A classic example of prepaid expenses, depending on where you are, is property taxes. And property taxes are a great example of when you many times prepay in advance of a closing and you have to be reimbursed for those particular items. This is a good question, but the answers can be long, and sometimes these can kind of tire out the reader. So be careful here. Read the answers very carefully, but also sort of read them, take a pause. Don't rush through these because these are, these long-winded interrogatories and questions, and they sometimes can tire out the student. So just be careful here and just focus, and you'll do fine. And we'll see you in the next one. Question number 25. Which of the following tasks requires a mortgage loan originator license? Letter A. Advising clients on real estate investment strategies. Letter B. Conducting a credit check for potential borrowers. Letter C. Negotiating loan terms and conditions with lenders. Letter D. All of the above. And the answer is letter D. All of the above. So classic on these types of examinations. You want to know when you need a loan originator's license and when you do not. And there is some stuff called the Uniform State Content, a UST, Uniform State Test. And those items in that particular section of your book, these are going to be things you study. You're going to find these types of questions here, like when does a loan originator need to be licensed versus when they do not need to be licensed. And you can learn about things like processors and what is the definition of an MLO, etc. So you want to know these. And all of these three things, advising clients on real estate investment strategies, conducting credit checks for potential borrowers, and negotiating loan terms and conditions with lenders, all are going to require loan originators licensing when it comes down to being employed at a loan originator's office in terms of being a mortgage broker or being a mortgage lender or affiliated with thereof. So you want to know these. These are great questions. And there we go. All right, 25 questions. Hopefully they'll serve you well for your studies with your mortgage licensing examination. By the way, we're creating a ton of new content to help you study for this examination, as it's been something that I've trained for many, many, many years. Good luck with your studies. Good luck on your exams, and we'll see you